Okay, so in today's video, what we're going to be looking at is the US dollar index and the DXY. And this series of charts appeared in not last week, but the previous week's edition of the weekly macro themes. So the weekly macro themes report is our institutional service. It covers a range of assets, markets, and economies, and the objective is to deliver chart-driven insights for portfolio managers. And so today what we're going to be looking at is a couple of charts that really sort of present the case for the outlook for the US dollar index. And so the first chart that we'll look at here is the chart of the US dollar index versus two sort of interesting indicators here that we've designed. So the first one is the blue line, the light blue line here, which you can see on the chart. That is what we call the yield support indicator, and what that's designed to capture is the amount of yield support for the currency. We've found that really it is a key driver, and it's a real key fundamental driver. Looking at the blue line, what components go into that are the G10 interest rate differentials. So that's also 10-year bond yield differentials, short-term policy rates, and also real short-term policy rates. And so you get a composite picture there. Sometimes it's one that's more driving it than the others, but overall you can see on the chart there that in the times where it's seeing considerable support, it's often driven by that yield support. And also when in times where the market, the bull market ends, you can oftentimes see that the yield support starts to go out the window. Now the red line is more of a sort of a thermostat in a way. What it measures is a combination of positioning and valuation. So that's speculative futures positioning and my own composite valuation measure. And so what that's designed to do is when it goes to a very high level, it's a Z-score by the way, when it goes to a very high level, what that represents is a market which is overvalued and overcrowded. And when it goes to the very low level, it indicates a market which is undervalued and oversold. So, and you can see there when it goes to extreme lows or extreme highs, it oftentimes will mark a turning point in the market. And when you have alignment between the two, that's oftentimes one of the most compelling setups, like just prior to that sharp rally there in the US dollar, in 2014, 2015, you had a shakeout in the positioning and valuation indicator. It came down to very low levels, and that was coming at the same time as yield support was actually quite strong and improving. And so from here you can see that the positioning and valuation indicator is actually at quite high levels, and normally that's indicative of a market that's going to struggle to rally. At the same time, you've got considerable yield support, and as we get more Fed rate hikes, that's probably going to be something that's going to put a bit more support under that. And certainly there is probably a bit of a window where the US dollar can actually perform further, simply on the yield argument. The Fed's probably going to get a couple more rate hikes out the door before some of the other central banks, such as the ECB, would start to look at hiking. In fact, as long as we're talking about upside risk, it brings to mind the other two charts. I guess the first one to look at would be the shadow differentials here, and what that looks at is it looks at the interest differential across the shadow policy rates. So this is interest rate that is designed to capture what the monetary policy rate is, but adjusted for the impact of quantitative easing. So you can see that it's the US against the other big quantitative easers, Europe, Japan, and the UK. And looking like that one, there's times where it didn't work perfectly, but you can see there that it's basically pointing to a lot of upside risk, and so it's one to keep in mind. You can see the other one is, looking further across the page, the analog chart. So analog charts are always a little bit suspect, but it just goes to show what kind of what previous markets have been through, what previous bull markets have been through. You know, if you compare it to the bull market of the late 90s, you know, you could argue that it still has some way to run on that basis. But, you know, I would probably still focus back more on this chart. You know, the fact that you have seen that yield support. I guess, you know, when you go to build conviction, you'd ideally like to see a drop on that red line, a bit of a shakeout before, you know, really building your conviction on the long side. But then again, you know, there has been times when positioning and valuation has been quite up there, but because you've had sort of considerable yield support, the market's been able to rally further. So that would be all on that one. I guess, you know, putting US dollar in context, it's has a pretty key impact across a lot of markets. So, you know, when you have an opinion on the US dollar, certainly that it could go up, that presents a risk or a bit of a headwind for things such as emerging markets and commodities. So it's certainly something that you should be keeping at the front of your mind. And I'll just leave it there. And if you've got any comments, questions, leave them in the comment section below. So feel free to subscribe to the channel, and I'll also put a link into where you can find more information about this report. So if you wanted to subscribe or get a trial, or even just have a look at the copy. And so, you know, there we've got the bottom line from the report. Despite the dilemma and the Dixie drivers, which is this one, there remains material upside risk. And that is that.